We start off with what might be a major warning signal for the markets. Commodities rallying again today, bringing their gains for the week to more than 13%. The dollar rising in lockstep, hitting its highest level since May 2020. That's traditionally not a good thing for the market. Not surprisingly, stocks pulled back again today. The S&P back in correction territory, down more than 10% from its all-time high. The Dow closing out its fourth straight week of losses, and the Nasdaq shedding more than 1.5%. But is there even more downside from here? Some pretty extraordinary moves for the week. If you take a look at the individual commodities,
Amazing.
The dollar, the Dixie was up 2% this week alone. Tim, what do you make of this? This traditionally doesn't happen, and it's traditionally a very bad thing for the market.
Right. Traditionally, folks, when the dollar's rallying, not good for commodities, and it's typically been a period where actually you've also then seen emerging markets and other things sell off. But obviously, this is not only a flight to quality in favor of the U.S. dollar, but this is a flight to quality in terms of gold. And for those people that have been kicking around gold and saying it hasn't done its job, it has done its job. Look at that chart from 2018 to current and where we are. And I actually think we're breaking out. I think the trades may actually be in the other PGMs or precious metals. I think silver, I think platinum and palladium are also places to play. GDX I mentioned last night. I think the gold miners have not been run this well as companies at a time when also gold, I think, has some room to the upside. So difficult time. Obviously, we spent all week talking about inflation and the Fed and eroding buying power and the consumption that certainly is improved to the lower middle class, improved wages. This is not a good sign. And again, you look at the charts. Yes, some look overbought. Commodities are going higher. You know,
but all correlations are off. So we've established that at the top of the show. But when you look at it, the 10-year is rallying also, right? So that's a safety bet.
Right.
The dollar, safety. No one's buying the ruble, right? So no one, in theory, is going to be buying the ruble. But if you look at the real safety bet, the defensive names are defense stocks. Lockheed, Raytheon, General Dynamics, NOC, all up 20 to 30%. In the last 3 months. So where does it stop? Do you think that the spending on defense is going to be curtailed the next couple of months or ramp higher? It's going to ramp higher. NATO countries are going to be investing largely in defensive names and defensive stocks.
Okay, so defense is the way you go.
Sure.
But in terms of the signs for the broader markets, Jeff Mills, how do you interpret this? Some people might say this has been a precursor to recession, or do you say look through it and be like, you know, there are other things moving the dollar right now. There are other things moving the bonds.
I don't feel like you can look through it just yet. And I keep coming back to the idea that the market's just a little complacent. And I know everybody's talking about bull bear and the amount of bears is finally outweighing the amount of bulls and all these things. But if you kind of look at maybe some of the money where your mouth is indicators, put call ratio, so the amount of put buying relative to call buying, that's not as extreme as we would typically see in a real market panic. And we really haven't had that sort of freak out moment yet. Not necessarily that we need to have one, but there's so much going on out there. It feels to me like the market should be moving more to the downside. And frankly, that trend was already in place. So just for some technical hurdles, you know, until the S&P breaks above 4450, until the triple Qs break above 350, you know, we're in a clear downtrend. So I don't think things change until we see those levels. And you look at all of the usual suspects, Google, Microsoft, Amazon, all the same stories. And the last thing I'll highlight is just be really careful of rallies without improvements in credit. We saw a rally in the stock market in January, and credit spreads continue to widen. So any rally that we see going forward, I would like to see improvement in credit. If we don't see it, I think that's a warning sign.
Pete, in terms of how the markets have reacted, I mean, volatility, it's only at 31 right now. I mean, it did go up today, which is a little bit unusual to go up on a Friday, but we're only at 31. Yeah. You would think we'd be much higher.
Only.
I mean,
only 31.
There is a war going on in continental Europe, and there was an attack on a nuclear reactor, and we're at 31. That's my context.
Yeah, that's great context. No, you make a really good point, Mel. But the reality is this: that's a 2% move every single day. S&P 2% move every single day. So I think that's the part that is amazing to me, is the fact that we are up at these levels. And you said going into the weekend, you're 100% right, Mel. You know your volatility, because going into the weekend, obviously, you start to price in Saturday, Sunday, and what's going to happen Monday. Well, if it's at a 31, actually, Mel, that's telling you now that we were actually somewhere towards the middle 30s, 33, 34, going into this whole thing as we got closer to the end of the day. But I think the thing that stands out for me, we were talking about commodities. The speed at which we have seen, I keep using the word velocity, I'll say speed this time, the speed at which we see this movement in crude, in copper, in gold, name your commodity, has been absolutely extraordinary. And we all obviously know some of the different spots where Russia does have a very, very big stronghold. It's not in crude, but crude's been on this run, and it wasn't because of Ukraine, Russia. That's been on this run for over a year. It started off when the president got into office. So that's something that I think a lot of people just continue not to embrace. But when I say gold, gold's been really interesting because the last couple of weeks, when you go back to the middle of February and the move till now, it's been extraordinary, and they keep on buying, Mel. So this isn't over in terms of what the option markets are telling us. We had GLD buyers today that bought 75,000 of the upside calls in the GLD at the 235 strike. So that gives you a little bit of a perspective of how high they think potentially things can go in a period of time. Now, they're going out to September with those. Most of the other options that we've seen over the last couple of weeks have been a lot shorter term. But we are still seeing commodities to the upside. We've got to ride that. I think you've got to continue to ride that and roll with it until we see any indications that that's not the path that we should be on.
Copper at an all-time high. Wheat is up 40%. Tim, I mean, at some point, we were just at a point where companies started saying things were getting a little bit better in terms of supply chain, in terms of input costs, et cetera. And here we are, back to square one.
Think about what you just said. Copper, all-time high. All-time high. So is demand that strong? No. Is the supply disruption in copper that
yes,
significant?
It is.
No. Oh, okay. Well, Pete's building a house. I know Pete's been welding some pipes lately.
No.
He's right. There is demand in copper, and clearly, remember we call it Dr. Copper because on some level it's a measure of the economy. But this move in copper, to me, is not the economy going gangbusters. This is to me, a structural imbalance in copper, and I talk about this all the time, where I don't think Freeport and Southern Copper and some of the other global copper players have actually been reinvesting in their copper mines. And I think there's been a lot of volatility in certain parts of the world where they mine a lot of copper. So, I mean, this is part of what the story is, and I do get worried about this. Again, all-time highs in copper. So go back, though, to look at steel and iron ore and some of the stocks related to that. I think diversified miners, I think Rio Tinto, I think BHP, and we said this last night, it feels like 2010 fast money right now, but this is where we are. Commodities are long cycle asset classes, and I think we're really just starting to
How much do you think gold, the movement in gold is when we look at the oligarchs in Russia, and when you look at trying to get out of dollars or trying to get into dollars, and the flow of what they're trying to do has been halted? I wonder how much of that is trying to skate around it and buy gold in other different venues as well.
But think about, Karen Feinerman says this all the time. You can come up with almost any reason to own gold at certain times, and sometimes she scratches her head and she's right. But if you think about what's going on in central banks, and look, I'm happy with sanctions on Russia. There's no politics here. But think about the fact that you've got the U.S., Great Britain, and Europe saying, we're going to hold on to these assets. We're going to freeze these assets. This sends a message to every other central bank and every other country in the world, whether they're doing right or wrong. We want to continue to diversify, and gold will continue to be that. I also think this is ultimately dollar negative, although, like Jeff, I think the dollar is going higher here. I think we're going to see Dixie 105.
Yeah, back to the commodities, though, Jeff. I mean, regardless of why commodities are up, these are costs that companies and consumers will have to pay for. And so at what point do you start thinking to yourself, earnings maybe not look so good for the next quarter. They have to come down because of the increased costs. How many price increases are companies going to be able to put through to the consumer?
Yeah, I think you start to think about it now, honestly, because I've been talking about this for a while, and as we push in the second half of the year, I think we were already primed for a slowdown in the economy and a slowdown in EPS growth. So now I think with everything that's going on, that's actually gotten pulled forward, and I don't know that that's priced in. And really to your point, I think we're going to move from sort of these inflation fears to a growth scare, and that will be the narrative that takes hold. And that's really why I've been talking about growth stocks. I think the re-rating, when growth becomes scarce, investors look for growth where they can find it. So I think there ends up being an opportunity there. And ultimately, inflation becomes deflationary. There's going to be demand destruction, and I think that's part of the concern here.
Did Jeff change rooms on us, by the way?
What do you mean? Like mid-sentence?
I'm always somewhere else.
Different backstop for the general.
I'm all over.